So what if I told you that for the last decade, one of the most basic ideas in investing, diversification, was actually a losing strategy? Well, today we are digging into a 10-year period that saw this unbelievable split between two of the world's most important indexes, the S&P 500 and the Nasdaq 100. And what the data shows, it really reveals a whole new market reality. Let's get into it.
Okay, so let's start with a big number. Over that decade, if you had put your money in the Nasdaq 100, this is what you'd be looking at. A total return of 443.5%. I mean, that is just an absolutely staggering performance, no matter how you slice it. But here's where the real surprise kicks in. During that exact same time, the S&P 500, the benchmark for the entire US market, it returned 269%. Now look, that is a fantastic return, don't get me wrong, but the performance gap between these two is just massive. So what on earth happened?
All right, to really unpack this data surprise, we're going to break it down. First, what do the raw performance numbers actually tell us? Second, how did just a tiny handful of stocks, the Magnificent Seven, completely change the game? Third, we'll look at the four distinct economic phases of the decade. Fourth, how did each index handle the big market shocks? And finally, what does all of this mean for how we should think about investing today?
So let's start with the hard numbers. This is where we can really see just how different the paths of these two indexes were, not just in performance, but in risk, and even how they relate to each other.
Now, what's really fascinating on this slide is the compound annual growth rates, or CAGR. Take a look. The Nasdaq 100 compounded at almost 17% a year. That is a truly historic number for a major index over a whole decade. But then, look over at the S&P 500 Equal Weight Index, where every single company has the same influence. It grew at less than 6% a year. The takeaway here is pretty stark. The market's gains were not spread out at all. They were incredibly concentrated right at the very top.
And this brings up the whole question of risk, right? The conventional wisdom is always that the Nasdaq is riskier. And sure, it was more volatile, but the Sharpe ratio here tells a different story. It shows the Nasdaq was actually the most efficient index. It gave you more return for every bit of risk you took on. And as you can see from that tiny Sharpe ratio for the equal weight index, the price you paid for that safety was a huge hit to your returns.
And this right here perfectly illustrates one of the biggest changes in the market structure. By 2026, the S&P 500 and the Nasdaq 100 started moving in perfect lockstep, a correlation of 1.00. What this means is that the S&P 500 basically lost its identity as a diversified index. It became, for all practical purposes, just a watered-down version of the Nasdaq.
So you have to ask, what was the engine behind this huge divergence and all this concentration? Well, the answer lies in the incredible, unprecedented rise of just a small group of mega-cap tech stocks that didn't just lead the market, they pretty much became the market.
You know their names, of course. We're talking about NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla. These 7 companies, they're the ones that rewrote the rules.
If we rewind to the start of our decade, back in 2016, these top 7 companies made up about 12.5% of the S&P 500. That's a pretty healthy, broad-based market structure. Nothing too crazy. But just look at this. Fast forward to 2026, and that concentration had absolutely exploded to over 34%. Think about that. More than a third of the value of the entire S&P 500 was tied up in just these 7 stocks. A level of concentration like this is completely unprecedented in modern market history. And the performance numbers really show you why. From 2016 to 2025, these 7 companies together delivered a combined return of over 875%. The S&P 500 as a whole was up 235%. So the crucial takeaway is that the other 493 companies in the index, well, they were generating far, far lower returns. So to really get how we ended up here, we need to look at the decade's timeline. It wasn't just a straight line up. Nope. It was more like a journey through 4 very different market and economic phases. First, we started with the reflation and trade war era. Then came the pandemic bifurcation, which just accelerated everything. That was followed by the painful Great Reset of 2022. And finally, the explosive AI revolution that really defined the last part of the decade. 2020 was really the defining year. As the pandemic literally shut down the physical world, the digital economy became the only game in town. And this created the widest performance gap of the entire decade. You had the Nasdaq soaring over 47%, while the S&P, weighed down by all its physical world companies, only managed about 16%. But then came the hangover. In 2022, inflation was soaring, and it forced the Fed to hike interest rates really aggressively. This great reset, as we call it, punished those high-growth tech stocks because they're more sensitive to interest rates. So the Nasdaq fell almost 33%, way more than the broader market. And just when the tech is dead story was really taking hold, boom, the release of ChatGPT ignited the generative AI revolution. This one thing fueled an unbelievable recovery. The Nasdaq 100 didn't just erase its 2022 losses, it surged nearly 54% in 2023. That's more than double the S&P 500's return. Incredible.
Okay, so we've seen the year-by-year story. But how did these indexes actually hold up during the decade's biggest stress tests? Their reactions really tell us a lot about their fundamental character.
This table is really fascinating. During the COVID crash, which was a crisis of mobility, the Nasdaq actually dropped less and staged this sharp B-shaped recovery. Why? Because tech suddenly became the new defensive place to be. But during the 2022 inflation crisis, a crisis of valuation, it got hit way harder and had to endure this long U-shaped grind to get back.
And let's look at the most recent shock, the tariff crash of April 2025. When these sweeping tariffs were announced, the market just plunged over 10% in 2 days. But the second the policy was paused, the market staged one of its most violent single-day rallies ever. It just goes to show you how incredibly sensitive this market is to policy headlines.
Okay, so we've looked at the numbers, we've looked at the companies, we've looked at the key events. Now let's put it all together. What does this whole decade of data really tell us about the new rules of investing?
I think this quote just captures it perfectly. For 10 solid years, the textbook advice, diversify away from the biggest names, was exactly the wrong thing to do. The market actually rewarded investors who took on the risk of being concentrated in just a few dominant winners. And this chart right here really drives that point home. That massive gap between the standard S&P 500's return and the equal weight version's return, that's what we call the concentration premium. And this whole thing was supercharged by the rise of passive investing. You see, as the big tech stocks got bigger, index funds were forced to buy more and more of them, which created this powerful, self-reinforcing feedback loop. So let's wrap up with the key insights here. First, concentration wasn't some kind of risks to be avoided. It was the main driver of returns. Second, that old idea that value stocks would eventually come back and take the lead, well, it just didn't happen. Third, the S&P 500 has, for all intents and purposes, become a diluted version of the Nasdaq. And finally, despite all the excitement around AI, a policy mistake remains the single biggest risk to this market.
And all of this leaves us with the big question for the next decade. Will the productivity gains from artificial intelligence finally start to lift the rest of the market? You know, the other 493 companies. Or is this trend of extreme concentration just going to continue, with the magnificent few sucking up all the oxygen and all of the returns? The data from the last 10 years has given us a pretty clear verdict. But what happens next? Well, that's yet to be written.